My life journey was set when I was born that I was supposed to join my father's business, which was into construction. Like in any Bania family, you start business from very young age. One Mamaji, came from Delhi. He opened his laptop, did something, and at the end of the day, he said, I made money for today. I asked my father, please, I want to do this. Give me some money. He gave me 10 lakh rupees. But he gave me, and that 10 became 32 lakhs in a matter of 4 months. Because once you don't know anything, you think you know everything, right? When I went to sell my holdings, I couldn't sell them because there was no buyer in them. Once the dust settled down, that 32 became 2 lakh rupees, right?
Gaurav, first of all, thanks a lot for coming to this podcast and giving your time. I know you're a very busy guy, but one thing I really loved about you because I was looking at your posts on Twitter and on Substack as well. First thing I want to ask you this question is you run this company called 91 Capital, right? So how did you come up to this point and what led you to create this RIA firm?
Yeah, so I'll go like from the starting. Yeah. So first of all, thank you for having me here. It's my first podcast in life.
Oh wow.
So even if something is not perfect, so all credit should be mine. Sure. Because you have been doing it for a long time.
No, absolutely. As long as knowledge is there, I think people will love it.
Yes. So I come from a very small town. It's in Uttarakhand called Kashipur, right? And our family has this construction business. And my life journey was set when I was born that I was supposed to join my father's business, which was into construction. And I am Agrawal. So like in any Bania family, you start business from very young age, right? Once you are 12, 13-year old, you start accompanying your father or your grandfather to their shops, to their business dealings. You start, accompanying your father, grandchild to all the dealings, money dealings that are happening. So it started very early for me also. And since I was in the construction business, our family business was into construction. I was accompanying my father to construction sites, dealing with laborers, meeting politicians, because you know how construction work happens, right? You have to do a lot of stuff to get the payment. So, but what happened when I was in Dehradun, I was doing my bachelor's in business administration. I came back home for a wedding in the family, and I was around 18 or 19 years. That time it was 2008. So 2007 end. So there, one Mamaji, came from Delhi. He sat in a secluded room, and he opened his laptop, did something, and at the end of the day, he said, I made money for today. And when I looked at him, I said, okay, I am going and spending time with laborers, roaming around in sunlight, dealing with all kinds of politicians. And here is the guy who is doing something in the AC room and making money. So that was my starting point. Like that was my introduction to equity markets. Then I accompanied that Mamaji to his place in Delhi. I got my father's Demat account, opened. It took, it was a 40-page thing, I used to like gather everything, what has to be signed, then went back home because I was not 18 that time. So the account had to be opened on my father's name. Once it opened, I asked my father, please, I want to do this. Give me some money. He gave me 10 lakh rupees. And it was a very big deal. And I'm still very, very grateful to my father because had I been at his place, I don't think I would have given 10 lakh rupees to a teenager, for some whims. But he gave me, and that 10 became 32 lakhs in a matter of 4 months. Because once you don't know anything, you think you know everything, right? It's a very different concept. So I was trading into currency, options, crude oil, gold, everything I was doing. But then came the GFC crisis, and I was running the leverage book. And, first time I got the margin call, I didn't know what margin call was about, but he said, you have to sell your holdings. When I went to sell my holdings, I couldn't sell them because there was no buyer in them. So that's when I realized, okay, I said, I can't sell it. So the other guy says, no, you have to, fulfill it. Then I had to ask my father again some money so that I could meet my liabilities. So once the dust settled down, that 32 became 2 lakh rupees, right? In 4 months, that 10 became 2. But for me, I became from 32 to 2 because when it was 32, I thought my life is set, I don't have to study any further. This is what I want to do. But that one after that incident, what I realized is there has to be some method to this madness, right?
Yeah.
I have to spend time to understanding it because what 10 can go to 32 and 32 coming down to 2. If I can, think of a way where I can reduce that 32 becoming 2, then I think it's a great place to be in. So I went to Old Delhi from Dehradun, right? Because that time there were no Amazon, Flipkarts. And I didn't even know what to read. But wherever financial markets or, those words were written on books titles, I bought those books. I bought some 60, 70 of them. And you also know I am not from a very great college, but in those in these colleges you don't study, you just do socialize, you do friendship, all that. I was studying these books, and I was realizing how to invest in markets. After doing all that, after completing my education in 2010, I came back home, I joined my business, and I was also reading these books. I started a small blog on Indian microcap and small caps that time, which I ran for only 2 years. But in that while, I used to cover undercovered companies, write about their business model, and I think that was a starting to what I do now. And now also I run a 91 Capital blog. So I think the seeds were sown in that 2011-12 period. But I kept on doing the same thing, investing into those micro companies. I was going right, wrong in a lot of places, going right in some places, but I was getting some courage, and the motivation, and that positivity was coming every day. Okay, next decision should be better than the previous decision. So in 2012, what happened? A lot of my friends, they completed their education, and they were going out to Delhi, Bombay, working with the Deloitte, etc. And I was getting this FOMO. Okay, I'm staying back at my tier 4 town. So I should also go somewhere and do some job. And fortunately, one person, one investor relations firm slash investment banking firm called me after looking at my blog. Okay, why don't you come to Gurgaon? We have a job for you. You can write about the companies who are our clients because you write really well. We want you to glamorize their stories, and we'll give you job. And I was just waiting for that moment to come. So I said yes. It was a 25,000 per month job, and it was not even enough to sustain the lifestyle in Gurgaon. So I was staying with three other friends of mine, and because I was not getting time to research, I used to sit late at office. I used to spend my time researching and writing from 7 p.m. till 11 p.m. So one fine day, what happened is there is a fund manager, named Sonal Kohli. He had just set up his new fund. He called at 8 p.m. for to know about a company called MPS Limited, which was the client of this particular firm where I was working with. And I happened to invest in that company in 2012 at $50. It was around $140 that time when he called me. And I knew everything about that company because I was following it. My money was invested in it. And even though I was not representing the account, I wanted to meet him so much. Then I said, I know a lot about this company. Let's meet. We met the same night at 8:30 p.m. and we discussed everything but MPS. For the main company for which we were supposed to meet, we didn't discuss about that. So that was the first time I met any fund manager, and he said that he is setting up a fund. He asked what my interest was, this, that. And for next 8-9 months, we kept on exchanging thoughts on different companies. Then one fine day, he gave me an offer to come and be a part of his firm. The name of the fund is Bowhead India. It's I think a $700 million fund right now. But when I joined, it was just a couple of $1 million fund that do largely the founders' own money. And in that fund, I learned everything, right? It's basically starting from how you analyze numbers to how you meet the managements, how you do forensics. I learned basically everything about investing from him. Then obviously every person is a different investor. You add your own flavor to it. So I was there till 2022. And after that, for 1 year, I got an offer to become a fund manager at a large wealth management firm who were getting onto the product side. Earlier, they were only distributing it, but then they also launched their own PMS. And it was a small 100 crore fund which I was supposed to manage. And it was a fundamental based small cap fund. And also, the reason for shifting out from Bowhead is because the fund was becoming bigger. They were choosing to invest in larger companies where I had like less interest, right? So I joined this fund. Once I joined the fund, what was supposed to be a fundamental based fund, it became a quant fund because in 2022, thanks to Sandeep Tandon from Quant Mutual Fund, everybody wanted to have some kind of a quant strategy. So, and I had no inclination or no skill set or no experience about quant fund. Neither did I want to, learn about those things. So I was shifted to the product side where I was meeting the equity fund managers or PE or VC fund managers, and I was evaluating them, right? Because we had $4 billion of wealth which we were allocating to these managers. So when I was meeting these managers, two things became very apparent to me. One is the guy whom I was working with. He is supposed to be the best fund manager in India. I think today also I stand by the same statement. And second is, if not better, I, and and a co-founder of mine at 91 Capital, we both as a team, if not better, we are at least at par with almost all of them, whoever I am meeting, at least in the equity public market side. that gave us the confidence to start something on our own. And bull market was also, giving us an impression that we can do a good job. But what was good is, even in those volatile periods, our portfolio was not losing a lot of money, which gave us confidence. Okay, it's not only bull market, which is a reason for our, intelligence. We are doing okay in the falling market also. And most of the companies which we were holding in our personal portfolio was below 510,000 crore market cap. So once we decided to start something on our own, there were a few family offices, basically promoters of listed companies. They said they were of good relations, because at Bowhead we used to do research. We used to go and meet them very frequently, understand about their business. So they said, okay, if you want to start something, we will be your first client. So we started with only 2 clients. Now, in the last 2 years, those two have become four. We started with just 150 CR AUM. Now that's around 275. And that is what we do now at 91 Capital. We only focus on companies which are below 2-3,000 crore market cap, and 80% focus is over there. But we have some 10-20% allocation to larger companies also, which are 8,000, 12,000 crore also, to meet the liquidity and to have some kind of cash in with us, so that we can utilize that fund in a falling market. So we are always 100% invested, but 20% of the capital is into larger companies, which we use as an opportunistic way to sell them and buy these smaller companies again.
Interesting. So you said you're investing mainly in sub 3,000 crore market cap companies.
Yes.
Now, obviously, sub 3,000 crore market cap, there immediately some questions come is, we all know that returns are made everywhere across, right? But sub 3,000 mein there is a problem because information is less, and most of the times there are some promoters who do scam, right? And I know that you write very well about unearthing these weird looking financial transactions. So is it possible if we can look at some examples for the audience where sub 3,000 crores, what have you seen funny things happening in the financial statements?
Yeah, we'll get on to this. See, the incidences of fraud is very much there in this category, is because the number of companies are so much in this, right? You have like top 500 companies. So obviously they have become top 500 because they have done all the right things, right? The below 3,000 crore, there are 3,000 odd companies which are below 3,000 crore market cap, right? So every company, it cannot be judged on the same parameters as the top 500 companies are. But what we have realized is, in the investing in micro caps, it's about survival. If you are 100% invested, and if you are surviving these kind of volatile phases, the bull markets will take care of your portfolio. And when I say take care, they are like really wealth generating, generational wealth generating opportunities. So I'll just cover 3-4 examples, which I think your audience can relate to. It doesn't need any specialized databases as such, and those will be helpful. So the first and foremost thing, like in micro caps or in large caps anywhere, is cash, right? When I say cash, it is how much cash flow the company is generating from the EBITDA that is reporting. Because P&L is just an estimate. There is a saying that P&L is just an estimate. Cash is where the truthness lies. Right. So a lot of people, because Twitter and a lot of blogs, people have started checking the debtors. Right. If company's debtors, it is increasing, then it becomes negative. But beyond debtors also, there are a lot of ways in the balance sheet where, where the entries are rooted, and ultimately it shows up in the cash flow, right? So one of the examples I'll just talk about using the Excel is this company. So this company came out with its IPO in 2024, right? As you can see, over here, they did, this is the PBT that they did in these 3-4 years, right? So before the working capital adjustments in this particular IPO, where they did 20 crore rupees cash flow. But then you see come down, debtors 5.4 crore negative, inventory 6.3, so basically it nets off. Okay. But once you look at the loans and advances, which many people don't look at, right? There is a 55 crore negative entry. My God. If you go and read the explanation to this particular entry, it's a very funny statement. I'll send you the snapshot of this particular entry, what they've written in the annual report. And even a 12th pass out can make out that they are just, lying.
55 crores loans and advances while making
Sub 20 crore PBT. I met this company last year, and the promoter accepted to me, right, in confidence that they had to do this because of certain reasons. And they accepted that the numbers that they are showing in the P&L, they are all first.
Wow.
Right? Now, this company is just one example where it covers 2 points, that you should not just look at debtors, you should look at inventory, trade payables, as well as loans and advances, what kind of entries are being routed there. Because in many formats that I've seen, because a lot of people send us their resumes, we ask them to prepare a model. And while arriving at the free cash flow, they do only debtors adjustment. They don't take the entire working capital adjustment. Even in the capex also, a lot of times what happens, companies are also becoming smart, right? They know what people like us look at, so they try to have working capital positivity, but in the capex they'll do all kinds of routine, right? So it's important to look all of these things in entirety, and ultimately you have to look at FCFF, which is after capex, after this, even after adjusting for the investments they are doing in their subsidiaries, right? Which is not relevant in this case, but many companies, why they stand on balance sheets, they invest in their subsidiaries. Mostly these subsidiaries are based out, so outside India. You don't know whether that subsidiary is there only on paper or there is actually any business. But you have to take out all the things which is actually going out from the cash flow in front of you, and that is when you calculate the true free cash flow to the firm.
Got it.
Now, using the same example, since the promoter accepted that they are committing this fraud, and they are over-reporting the numbers, inflating the revenues, we use the same example to understand who are the auditors to this company and who are the merchant bankers. Because if the company's promoter just in the first meeting can accept this thing to me, it's very difficult for me to believe that the auditors and merchant bankers wouldn't know about it, right?
So they would know, and it might have happened with other.
Yes, yeah, yes. So I checked out that the same company, who else is being audited from the same auditor. So this particular auditor, called J Gupta and Associates, they are auditing 19 such companies, right? Now, all those 19 such companies, 16 of them have recently IPO'd in the last 3 years. Then I checked what could be the other similarity. I opened the prospectus of them, and I was just getting one merchant banker name again and again and again. The same merchant banker name was pulled up by SEBI, and they banned him temporarily for 3 months. And out of 1916 companies,
Had a problem.
had a not had a problem, but they were being IPO'd by the same merchant banker. Now, I'm not saying all the 16 companies will be fraud, right? I am saying I have got two different data points. The auditor is same, the merchant banker is same, and the company where these two vendors were involved, they were also this guy was apparently doing fraud. Now, I'm not sure whether these 16 companies are doing it or not, but this reason is good enough for me to stay away from them.
So because framework that you have said that
Yes.
I will be careful about this.
Yes, and now the burden is onto them, right? They have to prove over the next 4 or 5 years that okay, they are a reliable business models. They have to generate cash flows. They have to improve their governance qualities, have better auditors, etc. And then I might look at them after 4 years. But for now, it's a strict no go for me. See, for me, there are like 3,000 companies. Like I need a reason to say no to most of them, right? If I start saying yes to a lot of them, what will I do with a lot of those ideas, right? So this is just second example, or using the same, parallel from the first company, using that company, how I went on to do this. There's another thing which you can do is you can see who are the major public shareholders in these companies, right? And if those major public shareholders, you can click on screener on their names, you can see which are the other companies. And presence of those shareholders in those companies should, be prompting you to ask questions. I'm not saying you will have a black and white answer, but if you start asking questions, you might get to an answer which might help you to avoid a lot of loss in your capital, right? So all of these things we are doing only for one particular purpose, to not lose money. Because as I said, survival is the most important thing in microcaps. And if you can, survive these kind of landmines, the bull markets will take care of you, right? So in mid caps as well as in micro caps, a lot of times what happens, promoters have their own unlisted companies which are into similar businesses. While the listed entity where they hold 50-60% stake, they are doing all the capex, they are doing all the manufacturing. What these promoter entities do, they procure majority of the stuff, right? And they sell it and book profits in those unlisted entities where they own 100%. Right? So it is not like they're stealing money. It is just like they're shifting profits from one entity to another, right? And in this case, 40% is in the listed case, 40% is owned by the minority, so they are not getting these kind of profits. Like in this particular case, the company's revenue was 2,200 crore, right? Out of this, 1,750 crore was sold to the related party. Right.
So 78% of revenue was sold to related.
Yes,
Manages their own company.
Yes, promoter-owned company, and this is not for 1 year. Data is there. I am showing only for 1 year, but if you see for the last 10 years, you will find the similar kind of number.
Okay.
Now they are on this number. They are doing 250 crore rupees of EBITDA. This is the listed company. Now we went back to MCA. Right, on MCA you can see financials for the unlisted companies also. There the report, this entity which is owned by the promoter is doing 2100 crore rupees of sales. They had raw material of 1866 crore and traded purchase of 1760 crore. If you match the 1760 crore to the number which I showed you above, how much sales the listed company did to the related party, it matches 94%. And this is not for one particular year. Again, you can do it for 5 years. The number will come close to 95%. You see what EBITDA this company is generating is 184 CR. Now you put this thing in context that the listed company did 246 crore rupees of EBITDA.
Correct.
The related party is doing 184 crore rupees of EBITDA. So if you see the entire profit pool is 430 crore, 250 crore is being booked in the listed entity, 184 crore, which is 75% of the EBITDA which the listed entity has reported, is done in the private entity, which is owned by the promoter.
Wow. This is not even small revenues.
This is a big revenue, right? This is a big material thing, you know.
I mean, if he books everything into his main company, his valuation would double.
Yes. So, and it's a very very high profit generating, very complex engineering business, right? So, and these are like the top 30 business groups of India, at least.
So now I have a question that, how do we invest in this market? Because 3,000 crores and below, as you said, there are so many different weird things happening. So if as a retail investor wants to build like a framework, how does he actually do it?
So, see, at 9 Capital, we generally try to stay away from recently listed companies, right? And the reason why we do so is because till the IPO, company have, they have all the incentive to over-report numbers or over-report margins. After the listing, there are different lock-ins, for anchor investors, for pre-IPO investors till 1 year. And if you want to give them an exit, companies have to report good performance so that the broader market also gets invested and they can exit it to them. So one example which I talk about why we do it is a company called Uniparts India, right? They came with their IPO in 2022, right? You can see their last 4-5 years of EBITDA margins, they were 11 to 13% range. Suddenly in 2022, the EBITDA margin becomes 22%. Doubled. And many people ask this question on the con call, promoter had like really crazy and detailed explanation about why, what, how. We went each statement by statement, analyzed it, and also figured that all of those statements are not true. The blog is there on our Substack, where we, piece by piece, we analyzed all the information and concluded that the margins are not sustainable. Fast forward to 2 years, the margins came back to 15%.
Oh my God.
Right? So a 22% margin business coming 15%, even though on EBITDA you will see only a 7% decline, but the PAT goes down by 80%, right? Because you have a lot of fixed things below, depreciation, interest, a lot of other things are fixed.
So the stock price also fell eventually.
Yeah, stock price also fell eventually, yes. So IPO came at around 540 rupees. It made a high of 650. It made a low of 317, like half, in a 2-year period. So this is just as a normal retail investor, be very sure when you're investing in a recently IPO'd companies. You should know, at least read the prospectus, how many pre-IPO investors are sitting there, at what valuation did they invest. A lot of companies that you look at, read their prospectus, the last round would have happened just 3 months before the prospectus bill of file. And it would be like 70-80% lower than the price at which they are coming at. Second important check, which anyone should do is, their balance sheet sanity. The data should not be beyond a particular percentage, right? Again, this is all very subjective. There has to be some cash flow history. It's like if you're investing in companies which are 5 or 6 year old listed, right? You have 6 years of financial data. You can see whether in 1 or 2 years it's fine, they cannot make cash flow. But if they are not making cash flows consistently year after year after year, either you have to have a very solid understanding about it or you should just stay away from.
And you're talking about cash flow from operations or free cash flow? I'm talking about free cash flow. Free cash flow. Okay.
There is this dairy company which is like the largest company, right? When I was looking at this company 3 years back, I was surprised that this particular dairy company didn't make any cash flow for the last 12 years, right, at the free cash flow level. And it was a 20,000 crore market cap company. While in the same sector, I was finding a company which is supposedly, trading at 0.8x price to sales, while the other companies were trading at 3x price to sales, and this company was making cash flow. Today, that large company is just flat over a 3-year period, while the other company has gone up from 0.8x price to sales to 2x price to sales. And the sales has also gone up by 40%. So you have done your 4x over there, right? So that is second check, have the cash flow sanity check. Third is look at the shareholders, who are there in the above 1%. Look at those shareholders' track record, right? Previously, where they were invested, whether the pump and dump. You can see pump and dump article that we published on 91 Capital. It will give you a lot of insights onto how one can see whether the stoppage that you're buying into, is it being pumped or not, right? They are like very common characteristics. Again, I'll not go into detail. You can do those 3-4 checks basically, and also use the promoter name. Go on zoba.com, see which are the other entities promoter is a director in, right? You can just broadly see Google check about those entities. You can see the India, this there is this listed company, right, which has this SME page. You can see their details, whether they're into business or not, whether they're a similar kind of business or not. So after doing all of these things, you have certain idea whether the business is genuine or not, right? It's a 5-year-old listed company. It is generating cash flows. There are no hanky-panky shareholders in that company. After doing all that, you can be reasonably sure that the common mistakes which many people do, you will at least be not making them. There are obviously several others, but it will take certain time and effort to keep refining your investing skills over a period of time.
No, this I think is interesting. I'll give you an example. We were doing like this waste management report to learn and understand the sector, and we found one micro cap company resembles the sun, right? So again, everything looked amazing, everything looked good, and then we went to Google News and we saw an article few years ago. Ahmedabad में कुछ IT raid हुआ है, वही copper का ये वो, they used to take it for themselves and all of that, and they got caught with it for a big amount.
Yes.
And but now the narrative of that company is looking very nice, but everything is same. So we said, not like right now they might be doing a better job, but it's better to stay away from this perspective. Now, what about P ratio? Do you look at starting valuations when you enter, and if so, what do you prefer? Like, is it low digits?
So we have this parameter. I look at P&L based ratios, which are EV EBITDA, EV EBIT. EV EBIT more because of India's changes. Earlier, the rent used to be above EBITDA. Now it is below EBITDA. And PE ratio also. We would prefer them to be at single digit to early double digits.
That low, like very undervalued.
Very undervalued. And again, there are three perspectives on it, right? One is the on the trailing 12 months adjusted basis, right? So when I say adjusted, if there is any one-off income, it has to be netted off. If there is any one-off expense, it needs to be added back.
So the true value in the last 12
True PAT, right? And I'm not saying a 22% EBITDA or a 14% EBITDA, whatever EBITDA that we are using in the TTM, it needs to be adjusted for normal. It has to be normalized. On that parameter, it needs to be in that range. Second is cyclically adjusted earnings. For a textile company, let's say yarn manufacturing company, they do -2%, -5% EBITDA also. They do 20% EBITDA also. Neither the 20% EBITDA is true, nor the 2% negative EBITDA is true, right? You look at 15 years history, you take a median, you will arrive at a range, right? You do it for 3-4 companies, you will understand that this industry is broadly trades at 12% EBITDA margin. You take the revenue of last year, you see whether last year revenue is not going down or going up too high, right? You at least arrive at the normalized revenue, take the normalized EBITDA range, try to calculate the EBITDA and PAT, see what valuation is it trading at. In addition to that, you can also look at look at price to book ratio for these cyclical companies, right? And thirdly, for a growth investor, and we also have a lot of companies where we do growth, we look at 1 to 2 year forward also. But in those, we want to be very, very sure that we are not just following what investment banker is reporting, right? You are using your own mind. You are using your own projections. If the company is saying X, you're not just taking X on face value. You should take certain discount on it, make it realistic. On those numbers, it has to be 10 to 12x,
Got it.
So on those three parameters, if we find companies, then we work further on them. We do forensics, try to meet the management, visit their factories, because the companies we are dealing with, they're largely below 2,000 crore, right? In these cases, many of the companies are just there on paper. They don't even have their factories, right? They're just there on paper.
Yeah.
So at least you have to go and meet people inside the factory, see how the vibe is. And it's a very big funny thing. One particular big guy asked me, what do you do when you go to a factory, right? सो इट्स अ सिंपल थिंग, फैक्ट्री चल रही है इनकी नहीं चल रही है, आपको सबसे पहले वही देखनी है। पीपल से कि हम देखेंगे वेंडर कौन है, हु इज द एम्प्लॉय, व्हाट आर करंट एम्प्लॉयज आर सेइंग, हाउ मेनी ट्रक्स आर स्टैंडिंग, ऑल ऑफ दोस इज नॉट रेलेवेंट। फैक्ट्री हैज टू बी ऑपरेशनल, यू कैन आस्क फ्लोर मैनेजर, you get a lot of insights, right? Then you spend time with the management team, right? And I'm not saying just spend half an hour with them, because all of these managements these days are trained, they know what to speak, how to speak, there is a good market to them. But if you spend more than 1 hour with them, then they start becoming their true self, because they are trained for the first 30 minutes to 45 minutes, right? Once you be with them after 1 hour, right, which usually happens in plant visits, because plant visit is a full day program, right? You go meet the management, then you visit the factory, then you come back again, then you see promoter dealing, how is he dealing with these employees, what kind of calls is he getting, right? Who is coming and meeting them, you try to take cues from various things, and you start developing your view about the management, your view about the company, which is very important in this particular market gap. And so after doing all that, after doing your forensics, after looking out, you know in what case can I lose money in this, right? As I again say, it is all about survival. We don't want to lose money over a 2-year period in any companies that we want, right? Obviously it will not happen, we will have companies where we lose capital, but we are okay losing 10-20% of our capital in a 2 to 3 year period. We are not okay of losing 50% capital, right? So once you have that kind of a framework where you are making a portfolio of 25-30 companies, you have done your work, you are buying them at cheap valuations. When you buy cheap, it means that there is no story behind them. People are not following them here and there. And if you are buying them, you have done your work that it can grow meaningfully from there. And even if the P re-rating doesn't happen, only the PAT growth happens, then you can be sure at least you will not lose money, right? And if P re-rating happens, which happens usually maybe in 20% of your companies or 30% of the companies, that is luck. But that is a kicker to your returns.
Got it. And any examples you have, like any past examples where you have used this framework, it has worked for you?
Yes.
But before that, I want to see your Substack. Can you show me what type of things? This is mainly because I want people also to sit and read. Because guys, there's a lot of learning for you, and he's giving it all out, right? I mean, it's all there in the Substack, so you can read as much as you want.
And so see, we have this Substack called 91, which is digits91capital.substack.com, right? There we post one article on an average every week. So we talk about governance, we do deep dives, we talk about any hot sectors which one should be aware about. Like we wrote about gold financing and its risk recently. We also do, like, stallion was a very big theme, 70 rupees stock becoming 415 and back to 185.
Yeah.
We thought people would want to read about it, so we wrote on it also. Venus Remedies, which was under the radar stock till last year, we were the first ones to start writing on them. And even in this bad market for below 1,000 crore companies, it has gone up by 60% in the last couple of months. So we do a lot of stuff over there. We spend a lot of time researching companies, researching sectors. We try to put at least 10% of what we research on Substack so that it's beneficial to our readers also.
Beautiful.
So again, we have done a curious case on Uniparts, which is there publicly, right? There is a company which I talked about previously at an event, Consilient Line, where in 2020 November they sold their hotel property. The promoter entities sold their hotel property in Goa to the listed company at a valuation which is 4x of the listed companies like India, ISCL, and Taj, etc. 3 years later, they bought it back at 60 crore rupees discount, right? So in November 2020, you could have put money in any stock, it would have at least be 5x, right? And in this case, the company has lost 60 crore rupees absolute. Forget about the opportunity cost, right? So all of those things we cover on our Substack. But again, they are not recommendations, they're just learnings from them.
And some past examples I want to know from you, like something that you found like this in the past, you found as an opportunity, it had all your parameters ticked.
Yes.
What was your framework, thought process of buying it? How did you play it? And when did you exit gradually, or where did you exit?
Yes. So there was this large automotive company. It's very close to like what we do, right? It's a classic investment that we do. So first of all, it was trading below book value.
Below book value.
Below book value, right? And in auto companies, again, book value can also be inflated using reserves, which is called revaluation reserves. You can re-rate your assets and then add it to your net worth. So you have to take it off from that net worth. So because you are doing a historical analysis. If you see Screener in 2017-18 bull market, this company used to get 4x price to book. When we were looking at this company, it was trading at 0.8x price to book. And it's a listed company for the 20-year, right? It's not a recently listed company. Now, if you look at their businesses, all of those businesses were again cyclical. Their EBITDA band was moving, it was in the same band. And in their annual report, they were doing a lot of capex on EV side. They were doing capex on the Rolls-Royce engine side. We thought this information is there to press the trigger. But there was one trigger which happened. One of the very large credible guys, very large reputed AMC, one of those owners of that firm became independent director in this company. That was a big signal, right? If somebody is associating with this particular name, right? And mind you, this company in 2014-15, these promoters bought a jet also, right? They bought a jet of 600 crore rupees because they wanted to travel from Pune to Indore to visit factories. That was the reasoning they gave
For 600 crores.
for 600 crores. So that's why at that time we rejected it. But since it has happened like 4 years back in 2020, I'm talking about. In 21, I'm talking about. So we thought, okay, let's take a look at it again because company is doing cash flow. It's not like you buy jet planes every 5 years, right? And this guy becoming independent director was some kind of an indication. Okay, things are changing here. So we took a 3% bet here. It was just a 1100 crore odd company. Today it's a 26,000 crore market cap. Obviously, we didn't ride the entire 26x. We were buying till 3,2,500 rupees and we started selling above 10,000 rupees. So thing with us is we are never like buy and hold kind of guys, right? If we buy companies when we find great risk reward, we start selling them when we start finding okay risk reward, right? And we are always 100% invested. We think of not selling but switching, right? Because for us, there are so many other opportunities where we can put our money in. So we started selling this company from 10,000 onwards, and by 15,000 we were entirely out. Now it's a 20,000 rupee. And the interesting thing is, now when it's a 20,000 rupees stock, the company has first PPT ever in its life, right? And all the fund managers are going and meeting them.
I don't think anyone would know about the jet today.
I don't think so. But if you go to 2015 annual report, you will find it there, right? But nobody reads that much.
Yeah.
So this one particular company, which is like a classic R style kind of a company. Another company was again a power sector company. They used to make transformer oils, right? I have been tracking this company since 2013 because the company where I used to work, like investor relations, it was their client. So I was tracking it. That time I couldn't invest because in that setup we couldn't invest in the clientele companies, and it ran up too fast. 100 rupees stock becoming 600. But in COVID it came to 250 rupees, right? In July 2020, in its public con call, I asked them, like I along with 3 other people grilled them and asked a lot of questions. We got answers. We got lucky. We were able to buy it at 250 to 60 odd rupees. It went to 10,000 rupee also. A 40x in 3 years period. And but we were early in selling also. 5,000 onwards we started selling. So when I'm quoting these examples, it's not saying that everything is hunky dory. In case of this power company also, it was trading below book value. Debt to equity was just 0.2. There were histories of making cash flows, steady state cash flows. But the auditor was top big four, right? So the basics were checked. You are buying it at like historical low valuations. If things turn around, you can make a lot of money. So, but at the same time, I'll also caveat that everything is not hunky dory. While this segment makes a lot of money, this segment has the highest amount of loss-making companies also, right? So I'll not give any kind of wrong expectations to the listeners that you can just invest in any company and become 10, 20x. Only if you do the proper work, then, again, I'll not talk about the luck. Luck is aside. You can be lucky once or twice. But if you want to make a process-oriented returns, right? So this segment offers, if you have a good process, sound reasoning and logical mind, this segment offers the best possibility of generating it.
So if there was an investor who was investing in the microcap or small cap side,
Yes.
what is the maximum allocation you would recommend him to put? Because I know people who are putting 15, 20, 30% saying, yeah, acha karega. So what do you think is the
in one particular company?
in one particular company? Because people see small cap narrative भी आता है कि यही future है, ये large cap है, data center का राजा है, whatever, something will come. Every flavor, every theme changes.
Yeah.
What do you think to make it sustainable?
Correct.
What do you think is a good amount?
For a normal investor, like for us, I'll talk about, right? We never go beyond 8% of the cost price, right? Personally, I let it grow, right? While in the client's portfolio, we try to trim it also once it becomes like more than 12%,
Okay.
right? And a smallest position would be 1.5%, 2%.
Tracking position.
Yeah, tracking position. Tracking position will even be smaller. In clients, we don't take tracking position. Tracking position would largely be our own investments. But 1 to 1.5% is the smallest, largest 8% at cost price. Market price will have 12, 13%, but will not go beyond it. For a novice like general investor, I would say 2 to 2.5% is a very meaningful exposure. If you are just talking about these companies which are below 2000 crore, you don't have to be like make everything, every return out of one particular company, right? You can have so many opportunities in your portfolio, and 2% kind of allocation is good enough. In fact, I'll give you an example. I'll not name this investor, but he is like my second mentor. He started his journey from 1 lakh rupees in 1999. Today he is worth 700 cr.
Really?
Yeah, he didn't get any cash flows outside investing. Everything is made via investing. And in his entire life, he has never put more than 2% in any company.
Just by 2%. That means his hit rate is very good.
His hit rate is very good. He's a super good investor, right? And his churning is also very good. So he has a lot of 100x's, but he has a lot of 3 to 4x's.
So 3 to 4, 3 to 4, 3 to 4 karke.
Yes. Wow. And I can see his name in like a lot of companies beyond 1% holding.
No, like a superstar investor. Now, one last question I have for you. If you look at India now, because there is so much problems going on with macroeconomics, India and all of that, if you had to be bullish on like one or two sectors for the near term, because you said you don't do 10-year investing, let's say 3 to 4 years, what is some real theme where you're seeing actual growth playing out? Because when you invest in a company, you also look at the tailwinds coming in, right? So because we also get so many new sectors and everything is a theme today. What do you think is 2, 3 themes that you really like?
See, we generally don't look at those sectors which everybody is talking about, right? So that means we are always looking at sectors which are not growing. Because if this is a growing sector, everybody will be talking about that.
Correct.
Well, I'll tell you where I find a lot of risk reward, right? So a lot of government EPC companies, right?
Government EPC company.
Yes, they are like road construction and these construction companies. The government ordering has just dried up.
Yes.
You are buying a lot of these companies which are on my radar. They are at below book value. They don't have debt in their books. Their debtors were never a problem. They are again 10-year-old listed companies. A lot of value is there in this segment, right? Then this is one particular sector where we are spending a lot of time in. Banks, we generally, below 3,000 crore, you don't have banks. But we have a portfolio, like we want to have 20% allocation in above, 4-5,000 crore also because of meeting these liquidity challenges. So PSU banks, we find a lot of value in PSU banks also. RBI actions are again indicating that they want this sector to grow. They want capex to take place. So, and even, in a couple of companies, you can see the growth becoming better in this sector. So that is one sector which is again on our cards. Logistics is one sector which has not given returns for the last 10 years.
Correct.
Right. And if your GDP needs to grow, even though I am not a macro guy, I never talk macro things. We are very, very bottom up. But the logistics sector has to contribute, right? Most of these logistics companies, they have not made any returns in the last 10 years, right? While the balance sheet has cleaned up, their debt has reduced, their asset turnover is like lowest in the last 10 years. So a lot of capex cycle has already happened. Now it's time for the growth to come. So these are 2-3 places which many people are not taking a look at it. But these are places where we are spending a lot of time.
And do you also look at their sales growth that, at least it should be 10% or 12, at least at market rate or something like that, or you don't care about the sales?
We don't care about this.
You see how the company is today, how it was in the past, and you make a decision on the future.
We want balance sheet and cash flow to be in our favor. And if these two are in your favor and sector gets onto the tailwinds, then P&L will follow.
And we didn't talk about debt. So how is your take on debt in these companies? Do you like companies at 1:1 debt to equity, or do you look at some other metric? Or
no, debt, we have this parameter that if the debt to equity has gone beyond 2 in any time in the last 12 years, we'll not touch this company.
Means there is a history of over leveraging.
Yes. They have this history of over leveraging and it kills,
Wow.
Sooner or later it kills. Again, we have a problem of plenty. We need reason to say no, right?
Yeah.
And we are in the current market, we are so selective and it is paying off, right? So to say, in this market, there are more opportunities than we were finding last year, and there are even more opportunities than we were finding in 2024. Right, 2024 we were largely investing in large caps. Right, 2025 we were spending a lot of time in micro caps. Even we launched our services last year. Now Today, this week, you have been seeing how these small caps are being hammered.
Yeah.
So it will open up a lot of opportunities. Just be mindful of the valuation you are paying. Look at the 10-year history. You have a screener, everything with you, right? You can see the valuation charts on different parameters, and look at where the balance sheet and cash flow is, and invest.
And one last question here. How many years do I have to wait? Because that is a very important question. People don't know when to hold, how to hold. They don't have an exit kind of a framework. So if I invest in a very good company, I feel today, but if I have to wait for 3 years, then people say opportunity cost is gone. So is there some benchmarks like 1 year में इतना नहीं हुआ तो मतलब you're too early or something like that?
See, अगर आप देखोगे ना, if you think about it, most of us are looking to buy companies which can deliver returns in this year. That is where the most competition is, right?
Yes.
If you change your competitive area to a 2 to 3 year, there is a very less competition over there. Everyone on these calls asks, sir, आपका इस साल अगले साल पैट कितना होगा?
Guidance है
Guidance क्या है, पैट क्या है, right? But if you look at FY 2029, there are very few people focusing in those years. That is where the true value is. So if you invest for a 2 to 3 year period and have that kind of a time frame, that is the best time for micro caps. If you have lesser than that, you should not be in micro.
So 3 years and good expectation on return.
Yes.
Okay, that is good enough.
One thing I want to say here, many people, hate micro caps in India. Like globally also, micro caps are hated. And I don't understand this thing. You have VC, you have P. They are also investing in small companies, but they're loved. All the best like HNI promoters, they are investing in all the large PE funds. All these PE events and fund managers, they come in suits and boots and they are like well followed Economic Times article, this, that. Basically, PEVC has no liquidity, microcap has some liquidity. But in our case, some liquidity is hated and zero liquidity is loved. But this segment has the best chance of giving you returns in alpha, right? If you do it properly.
And I think because in this segment, the returns are the losses are visible.
Yes.
In PE, you don't know how much the VC.
It's like real estate, right? Whether you buy a real estate, you don't sell it at a loss. In PE also, now, there's this practice also in PE, they launch another fund, follow-on fund. The follow-on fund will buy from the original fund and the original fund will get the exit, right? So
it's instant gratification, but instant loss also. So that makes it scary for people.
Yes. And it's too volatile.
Yeah.
Right.
But this was awesome. Yeah, I think I am going to spend some time and read your Substack as well because I see a lot of interesting names. Even I want to read and understand, but only for knowledge, obviously. But again, Gaurav, thanks a lot for coming. I know this is your first podcast, and I should say that you've done a great job.
I'll not say that only readers will tell you. Yeah.
No, I think from a learning standpoint, I think that is the most important thing, right? As long as learning is that, I think people will be happy. So again, thanks a lot for coming on this podcast and giving it. Thank you. Thank you.